Investment firm Raymond James has started coverage of TMX Group, operator of the Toronto Stock Exchange, at a buy rating, outperform. Among other things, analyst Stephen Boland cites impressive diversification and big cash flow. Stephen joins us now. He's managing director and equity research analyst at Raymond James. Stephen, thanks very much indeed for joining us.
Thanks for having me on again, Andrew.
What are the one or two big things that got you to put a buy rating on TMX?
Yeah, I mean, I think the first thing is we have to remember this is not the company it was 20 years ago. It's not the company it was 10 years ago. The one thing that really has driven our interest right now is the growth in the global insights business, and a number of the acquisitions they've done over the past 5 years. It's added on to the legacy businesses, but the global insights business is really the fastest growing revenue stream, and it's got the highest margin. And this is something that they want to continue to grow over the next several years.
It's fascinating. They also have a global angle. Give us an idea of that. So not all the revenue from Canada. Is that a big part of their business right now, Stephen?
It isn't, but they do want to grow that to be about half of the revenue outside of Canada. That is the goal. They have pockets of different businesses that are outside. They have a very good, within the Global Insights segment, they have a business called Trayport. This is a European energy trading platform. It's got 10,000 licenses, 30,000 connections. It is one of the dominant players over in Europe if you want to trade energy. They also have, now they've consolidated the BOX exchange. It's an options exchange in the U.S. It has about a 7 to 10% market share, and they're looking to grow that. They've just made a bunch of tuck-in acquisitions as well, looking at global indices, global ETFs, providing those services. So they're getting away from the traditional cash equities business, the derivatives business. It's becoming more about different products, different segments of the market, and this is something they really want to grow again over the next several years.
And then you may have mentioned this, but they just pretty recently completed the acquisition of Vetify, a US-based indexing and data analytics company. So does that give them a serious foothold in the US market?
Yeah, it does, and global. It's an ETF provider. It deals with issuers. It deals with managers of ETFs, indexing for ETFs. And it was a high price acquisition, but the revenue for that is based on the AUM of their customer base. And so again, they've looked outside the traditional cash equities business to provide the ETFs, indices, more fixed income. Again, European energy trading. They're getting out of the traditional businesses, and that's kind of, again, why we really like the business at this point.
The dividend, not huge, the yield about 1.5%, but have they been increasing it fairly steadily?
They have increased it. I think the cadence of that may increase. The payout ratio is fairly low. And again, the free cash flow, they've basically generated about $1 billion in the past 2 years on free cash flow. They made that Vetify acquisition. They brought the leverage down into their comfort zone. But we estimate they're going to do about $1.3 billion in free cash flow over the next 2 years. And so the uses of capital are going to be acquisitions, and we believe a higher dividend going forward.
You remember years ago there was talk that they might merge with the London Stock Exchange. That never happened. Was that a good thing for investors, do you think, looking back?
It's funny, I was thinking about that, Andrew, because I was probably on BNN at that time. At that time, I never thought that would be allowed by the regulators, letting control of our national exchange to go. I think it was a good move for them. Basically, the new management team that's come in here under John McKenzie in 2020 has been very, very good for the company, and you can see it in the growth rates and the diversification of the business.
Right, yeah, they walked away from it in 2011. Wow, it's quite a while ago, but they said they didn't get enough support from TMX shareholders. And it was interesting to think that the flagship exchange could go into foreign hands, or be partly foreign owned.
Yeah, I mean, under the old CEO, I think they crisscrossed the country for a better part of a year. They never got competition or regulatory denial. I think it was a silent denial. And then, if you remember, Maple Group came in, the banks and a bunch of other large financial institutions came up and scooped it up, protected it for a number of years. And it's interesting now that the Maple Group, the holders, are pretty much gone.
And what about rival exchanges? We've seen startups come and go, CBOE, for example, but have they taken much market share from the good old TSX?
I think there's two businesses that for a long time that people thought that there was going to be some competition. The first would be listings. There is two exchanges, CBOE and the Canadian Exchange. One does basically ETFs. The other one does microcaps. That's not really the business of the TSX or the TSX Venture. And so they do have a number of listings, but it's not, I don't think the market cap of those are quite material. The second thing is definitely the equity trading business. If you remember 15 years ago, there was a number of ATSs that came up from the US, Omega, Chi-X, Neo, things of that. And, the banks have started another exchange called Alpha. Right now, in equity trading, the three platforms that the TSX owns or TMX owns have a 50 to 60% market share. So they haven't given that up. And that's been very steady for probably 6 or 8 years now. So we think that the threat from global players coming into Canada is relatively small at this point.
And Stephen, you may have touched on this, but for a long time, they've made a lot of money selling data, which is a pretty low cost thing to provide. Is that pure profit or nearly pure profit for them?
Yeah, I mean, and that's part of the global insights business. I mean, data links is one of the segments, and that's traditional real-time equity market data, level 1, level 2, and that's been, co-location, benchmark and indice data. That's all under data links. And then again, we mentioned Tradeport and Vetify. That's all part of the global insights business. And for the most part, it is just data and selling subscriptions and licenses.
Stephen, always great hearing from you. Thanks very much indeed.
Thanks very much. Thanks, Andrew.